Every January, the market turns into a costume party. Everybody suddenly becomes a prophet. One man predicts the 10 stocks that will soar. Another man predicts the 3 industries that will collapse. A third man explains why this will be the year of some fashionable phrase that sounds intelligent enough to travel across social media and just vague enough to survive being wrong. I have never had much interest in that sort of performance. The market does not owe me a calendar. It does not ring a bell and say, Warren, now is the exact month when your thesis will be rewarded. If I am going to put money to work, I want a much sturdier reason than annual theater. I want to know where the economic power sits. I want to know who controls the bottleneck. I want to know which business still gets richer after the headlines leave. I want to know which management can turn revenue into free cash flow instead of turning free cash flow into excuses. And above all, I want to know which parts of a great theme are genuinely necessary and which parts are merely fashionable decorations attached to it by hopeful investors. That is how I think about a year like 2026. A lot of people will call it an artificial intelligence year. That is too shallow for me. Artificial intelligence is not an investment thesis by itself. It is a condition, a demand wave, a reallocation of capital, a new pressure placed on data centers, electricity, networking chips, memory software, cooling, and the simple physical problem of getting more useful computing done at lower cost. When people say AI, they usually mean excitement. When I say AI, I ask a much more practical question. Where does the money have to go before the excitement can become revenue for someone else? That is always the better question. The public likes the glamorous layer. It likes the chip everyone talks about. It likes the software demo that makes a room gasp. It likes the robot video. It likes the quantum headline. Fine, but the profitable layer is often one step lower, sometimes 2. A gold rush is not only good for the man waving the map, it can be very good for the fellow selling the picks, the shovels, the rails, the roads, the water rights, the generators, and the warehouses. That is how I want to think, not as a fan of technology, as an owner of businesses. There is a difference. So if I were forced to explain what kind of businesses I would want around me in 2026, I would not give you a list and tell you to salute it. I would tell you a story about a machine so large that the public only sees the sparks, while the owners of the best pieces quietly collect the economics. At one end of that machine sits the obvious hero, NVIDIA. You do not need me to tell you it is a remarkable company. The market already knows. That is why the question is not whether NVIDIA is good. The question is what exactly makes it so good, whether that goodness is durable enough to justify continued ownership, and what else around it becomes essential as the whole machine grows. NVIDIA is no longer just a chip company in the old sense. A simple chip company can be copied, underpriced, out-cycled, or left behind. NVIDIA has become something more complete. A platform, a system seller, a company that is not just dropping silicon on a loading dock and hoping the customer can do the rest. It is selling compute systems, networking relationships, software layers, and a roadmap for how this whole extraordinary appetite for acceleration can continue scaling that matters. Very much the source document makes the point I think is exactly right. The center of the story is no longer just training. The world has now discovered that once a model exists, an entirely new appetite appears post-training inference. Serving the output to real users at real scale, that changes the economics of the entire market. It means the spending wave is not a one-time celebration around building a giant model in a dark laboratory. It becomes an infrastructure problem, a continuing one. And continuing infrastructure problems are where long-duration businesses live. NVIDIA's data center revenue growth in the source material is extraordinary, and more important than the sheer number is the fact that the company keeps widening the field on which it competes. The ordinary investor often sees only the product. The smarter investor sees the stack. If the hardware is strong, the networking is integrated, the software keeps deepening, and the customer learns to buy complete systems instead of individual pieces. Then the company gains something precious. It gains dependency. And dependency with customer goodwill is one of the finest forms of moat. Still, I do not like worship. The market punishes worshipers. So when I look at NVIDIA, I do not ask whether it is a miracle. I ask whether the revenue engine remains tied to a secular modernization that has years left to run. The document argues that most of the world's computing infrastructure still has not fully transitioned to accelerated compute, and that is the sort of statement I care about. Not because it sounds exciting, because it describes runway. Runway is what turns one good year into many, and if there is runway, there must also be supporting infrastructure. The supporting infrastructure is where the next layer of opportunity begins. Take Arista. People always want to own the hero and ignore the plumbing. That is one of the oldest errors in investing. Heroes are visible. Plumbing is required as these AI clusters scale. Networking stops being a background line item and becomes the difference between a beautiful rack of expensive chips and a machine that actually performs at useful scale. The source material captures this well. It points out that GPUs get the spotlight while Arista sells the switching fabric and software that allow those clusters to function. That is exactly the sort of position I like. Not because it is hidden, because it is necessary. Arista also has something I love far more than a beautiful story: cash generation. A lot of infrastructure businesses talk as if their importance should excuse mediocre economics. I have no interest in that bargain. If you are indispensable, wonderful. Show me the free cash flow Arista. S pattern in the document is attractive precisely because profitability is scaling faster than sales, and because the balance sheet is fortress, like when a business combines structural necessity with rising margins and a giant net cash position. It gains something that is easy to overlook in speculative markets: flexibility. Flexibility is underappreciated when money is easy and deeply appreciated when cycles change. A company with cash, no real balance sheet stress, and a place inside a long duration spending wave does not need the market's kindness to survive the next rough patch. That is a meaningful difference. Now let us go one layer lower still. Compute demands electricity, not in headlines, in hard physical terms. You cannot chant AI loudly enough to power a data center. You need land transmission, transformers, cooling, and above all, inexpensive power in the right places. This is why the applied digital story is interesting. The public hears a tiny company associated with AI data centers and imagines some little speculative satellite around the real winners that may or may not prove true over time. But what caught my attention in the source text is that the company is organized around one of the only constraints that genuinely matters when demand outruns capacity. Power costs. There is a practical beauty in finding cheap electricity before everyone else realizes it has become scarce real estate. That is not merely a commodity input. That is a strategic advantage if it is secured early and contracted intelligently. The document's emphasis on long duration, low cost electricity and power. Rich areas such as North Dakota is exactly the kind of hard asset thinking I like. The market often values data center stories by headline megawatts and fashionable customer names. I would rather know what the kilowatt hour costs and whether those economics still look beautiful when the campus is actually full. This is a more speculative story than Arista or NVIDIA. That must be admitted plainly. The margins are not yet where mature facilities should be. Execution risk is real. Scaling a campus is not the same thing as tweeting about a campus, but there is a very particular attraction in a business whose value will be determined not by whether AI remains a hot phrase, but by whether capacity gets placed into service and leased on rational long contracts. That kind of question, while still risky, is at least rooted in something real. If 100 megawatts of live capacity can produce roughly $200 million in annualized revenue, as the source argues, then the execution matters more than the macro narrative. I always prefer businesses where the next chapter is decided by operational reality rather than by continued market enchantment. Now, let us change worlds completely, because one of the biggest mistakes in thematic investing is thinking the theme must live in one industry. It does not. The same hunger for automation, autonomy sensing, and machine decision making that powers commercial excitement also enters defense. And once it does, the economics can become unusually sticky. AeroVironment is fascinating to me for that reason. This is not a pure science fiction moonshot. It is a company whose products have crossed the boundary from concept to deployment. That boundary is one of the most valuable in all of investing. People routinely overpay for concept and underappreciate deployment. A system that is combat-proven, produced at scale, and then extended through backlog into multi-year programs deserves to be understood differently. From a defense hopeful with a beautiful slide deck, the document notes that production for its key Switchblade products increased dramatically and that funded backlog expanded materially. That matters because backlog is not applause. It is economic memory. It tells you the customer has already voted. Now, the margins in the text look ugly in the near term because of acquisition accounting and mixed changes, and I am not blind to that. But this is one of those situations where the shape of the business changed before the reported profitability had time to normalize. I like those moments if the integration is sound, because they are often when the market temporarily understands only the scar tissue and not the mature earning power. Still, discipline matters. If you buy a defense technology platform during a messy integration, you are not buying certainty. You are buying the right to watch whether the operating leverage and margin recovery actually materialize. That is why I would frame it as an operational watch, not a devotional asset. The next name, IonQ, is where many people will lose their heads. Quantum is exactly the sort of field that attracts people who want to own the future before the future knows what it is worth. That can be profitable once in a while and ruinous much more often. So when I approach a name like IonQ, I begin by assuming that most people discussing it are far more enchanted than informed. That is not an insult. It is a pattern. The source gives the company credit for beginning to turn from a research story into an operating one through a material step up in revenue and through a deliberate decision to embed systems early, even at unattractive near-term margins. That is intellectually interesting. It suggests a business that understands platform entry may matter more than immediate prettiness. But quantum remains, for me, an option-like situation, not a core fortress. That distinction is important. A core fortress position is something you can reasonably expect to compound through cycles. If the industry remains roughly as attractive as it looks, an option-like situation is something where a small amount of real progress can transform the future economics, but where the range of outcomes remains broad enough that humility is required. IonQ may become very important. It may prove that early embedded relationships and fidelity advantages really do create a platform position, but I would never speak about it with the same confidence I would use for a broad market giant with visible cash flows and obvious installed base power. I have always believed the right way to own the future is not to fill your whole house with it. Keep the future in a room you can afford. That is how grown people speculate. Now let us speak about the picks that look most Buffett. Like on the surface, even if the source itself is written in a growth, investor voice. Amazon is one of them. I know exactly why so many people get Amazon wrong. It is too large for them to feel they are early and too boring at the wrong moments for them to feel they are smart. That combination is wonderful. The document makes an excellent observation. Amazon often moves in bursts, then spends long periods going sideways while the business catches up. That is the kind of pattern that punishes tourists and rewards owners, because the tourist wants constant confirmation, the owner wants operating leverage, widening cash generation. And a business whose strongest segment is beginning to reaccelerate before the market fully cares. AWS matters here, not because cloud is a new word, but because high-quality infrastructure services combined with broader retail and advertising economics create one of the few mega-cap businesses that can still surprise the world through earnings power rather than through mere narrative. The source notes the dramatic surge in operating income and free cash flow along with an AWS reacceleration and a share price that, relative to the SP, has been boring enough to be interesting. That is classic fertile ground. When a giant company quietly repairs margins, restores cash flow, and then starts funding the next build-out from strength rather than desperation, I pay attention. A lot of people think Amazon is already too obvious. Maybe the right question is not whether it is obvious. The right question is whether the next 5 years of earnings power are still being underappreciated because the last 2 years of stock movement were too boring to flatter the impatient. That is exactly the sort of mismatch I like. AMD is attractive for a similar but not identical reason. The document frames it beautifully. The stock is being priced as though growth is slowing, while the underlying business is still scaling, especially in data center with a valuation that does not fully reconcile with that growth. Now, I do not worship valuation ratios in isolation. People make all sorts of silly mistakes with PEG ratios and forward numbers because they want precision where only judgment exists. Still, when a company is expanding materially, improving cash flow, deepening into more valuable parts of its business mix, and yet the market narrative remains skeptical enough that the valuation refuses to become enthusiastic, that can be fertile territory. The important thing with AMD is not to treat it like the cheap imitation of NVIDIA, that is lazy analysis. The more useful view is that AMD is one of the few companies large enough, technically credible enough, and strategically important enough to supply an alternative system path in a world where customers do not want a single vendor destiny. Alternatives matter in capitalism. Alternatives tend to earn more than people expect when the dominant provider becomes too essential or too expensive. This does not mean AMD wins everything. It means it may not need to. If the total pie is enormous and AMD's slice can still grow faster than consensus expects while the market keeps pricing the company, like the growth will fade quickly, then the spread between expectation and reality can be generous. Lam Research, to my eye, is perhaps the most quietly Buffett. Like of the semiconductor names in this group, I do not mean in business age or style. I mean in economic character. The source describes something I find very attractive: long-range revenue growth, structural share gain, expanding operating economics, a better cycle profile, and a position inside the manufacturing complexity that only gets more valuable as chips become harder to make. This is the kind of business the public chronically undercelebrates because it sits behind the glamour. Wonderful. I like businesses behind the glamour. As memory stacks get more demanding and advanced packaging requires more steps, the companies selling mission, critical manufacturing tools gain a kind of hidden toll booth quality. The source notes that HBM growth materially increases Lam's content per chip through more etch steps, and this is exactly the kind of dynamic that appeals to me. The public sees the chip, I ask, who gets paid every time the chip becomes harder to manufacture? That is the better question. A business like Lam can look cyclical, and it is cyclical in the ordinary sense, but not all cyclicality is equally dangerous. A company that captures upside, protects margins relatively well, returns capital, and deepens its relevance in the next technical cycle is not simply a slave to the old memory, boom-bust pattern. It may be becoming something structurally better than the market's stale mental model allows for. That is where good returns live. Now, the document also includes a sponsor segment about mining, particularly a bundle of critical minerals tied to AI infrastructure, electrification, and resource control. I am not going to pretend I think about early-stage mining the same way I think about Coca-Cola. I do not. Mining is a difficult business, capital-hungry jurisdiction, sensitive, operationally messy, and prone to management teams who spend money more enthusiastically than they create enduring shareholder value. But the broad point hidden inside that section is still worth studying. Every great industrial transition eventually becomes a materials problem. You cannot digitize your way out of copper demand. You cannot meditate a power grid into existence. You cannot build AI data centers out of slogans. steel, copper, rare inputs, transmission, uranium, and all the surrounding physical layer eventually step into the foreground. That is not always best expressed through a single junior miner, but the thought itself is sound. Great themes always create second-order winners in physical bottlenecks. Ignore the physical layer long enough and you end up understanding only the press release and not the economy. This is what ties all these names together for me. The source writer thinks he is making 8 stock picks. What he is really doing, perhaps without fully saying it this way, is mapping an ecosystem. Networking, power-rich data center capacity, defense autonomy and sensing, quantum optionality, compute platforms, semiconductor tooling, cloud infrastructure with operating leverage. Alternative AI compute suppliers, that is a much better frame than a year-end stock parade, because once you think in ecosystems, your judgment improves. You stop asking which stock sounds hottest. You start asking which layer would still matter if the theme cools temporarily, but the structural build-out continues. That is a better question. I do not want businesses that need perfect sentiment to survive. I want businesses that get richer because customers have no choice but to keep spending if they intend to keep building. Arista has that flavor. Lam has that flavor. Amazon, in a different way, has that flavor. NVIDIA obviously has that flavor, though one must stay sober about the price of magnificence. AMD may have it if the alternative provider logic deepens the way the source expects. Applied Digital is more developmental and more exposed to execution, but it at least lives near a real bottleneck instead of a theatrical one. AeroVironment has a defense path durability story if the integration works. IonQ is the smallest and least certain, which means it should be treated with the most humility. That is how I would rank the certainty spectrum. And certainty spectrum matters. One of the great errors of modern investors is that they treat all thematic holdings as if they deserve the same portfolio weight simply because they belong to the same exciting story. Nonsense. A speculative quantum name, a highly cash generative networking business, and the dominant compute platform in the world do not belong in the same mental bucket. The proper response to them is different. You do not marry every child at the party. You decide who gets a house, who gets an apartment, and who gets a hotel room. That is portfolio construction. It is not enough to be right about the direction of a theme. You must also be right about the quality of the economic expression you choose and the size you attach to that conviction. This is another reason I prefer long narratives to annual pick lists. A list flatters equality where no equality exists. A narrative lets you understand the machine. Understanding the machine matters because themes change. If interest rates shift, if AI spending pauses, if one link of the chain becomes overbuilt, if power constraints relax in one geography and worsen in another, the winner may not be the same part of the ecosystem each year. But if you understand the ecosystem, you have a much better chance of staying inside reality rather than clinging to a stale label. The world is full of investors who bought a story and later discovered the story had moved one layer down while they were still staring at last year's hero. I do not want to be that investor. Now let me say something less flattering and therefore more useful. The source document contains a great many growth statistics, upside estimates, and analyst percentages. Fine, they are not meaningless. But analysts are not in the business of protecting your capital from your own emotional needs. They are in the business of explaining present optimism in a respectable language. Sometimes they are right. Often they are merely current. I have no interest in a 12-month upside target except as a clue to sentiment. If I buy a business, I do not want a one-year romance. I want a long arrangement with a partner whose economics improve, even if public enthusiasm has a cold season. That is another reason Amazon and Arista appeal to me more than highly theatrical names. Their economics do not require a standing ovation every quarter, and that, in a noisy market, is a very underrated virtue. I also want to say something about retirement, and the strange need many people have to prove it is not too late. The source writer tells his own story of beginning later than the average person and still retiring after a 15-year career arc. I think that part matters more than it first appears. because a lot of people ruin themselves by waiting for the perfect starting line. They say, I am too old, I started too late, the best gains are gone. The world belongs to people younger than me, smarter than me, closer to the technology than me. That is a poor excuse. A market does not care what age you were when you finally learned to allocate capital sensibly. It only cares whether you are doing it now and whether the businesses you own can still compound. You do not need to have bought Microsoft in the 1980s to benefit from owning strong businesses today. You need only enough discipline to stop confusing lateness with impossibility. The world is always trying to teach you that your best window is behind you. Sometimes that is true. Very often it is merely an excuse worn by hesitation. The better question is not whether you are late. It is whether the capital you control today can still be placed into businesses that possess long runways, improving economics, and management teams capable of turning growth into free cash flow. If the answer is yes, then stop whining about the past and begin. That is the tone I would prefer. Now, if I were truly arranging a 2026 basket from these ideas in a Buffett-style spirit, I would do something the public often hates. I would demand hierarchy. NVIDIA and Arista belong nearer the center because their economic position and current business proof are strongest. Amazon and Lam belong in the serious owner bucket because their cash generation and installed position logic are sturdier than they look to the impatient eye. AMD belongs in the strong, but still being proven bucket, where the valuation mismatch makes it interesting, but not sacred. AeroVironment belongs in the operational turn bucket. Applied Digital belongs in the execution bucket. IonQ belongs in the option bucket. That is how grown people think. Not all good ideas deserve the same weight. Not all stories deserve the same trust. The market punishes people who cannot distinguish between a compounding machine and an exciting possibility. And perhaps that is the final lesson. A thematic year like 2026 does not belong to the person who can name the trend. Anybody can name the trend once it is on television. It belongs to the person who can translate the trend into economics, can distinguish bottlenecks from decorations, can rank certainty honestly, and can hold the right businesses long enough for operating reality to matter more than annual performance theater. That is the only sort of stock picking I respect. Not prediction selection, not heat. Economics, not annual drama. Long duration cash generation with the wind of a major capital cycle at its back. If I can find that, I am content. And if the market insists on making some of those opportunities look boring between bursts of excitement, so much the better. I have never minded being paid by boredom on the way to being paid by reality. Reality, in the end, is the only thing that counts.